Hello everyone, welcome to the Stock Trading Tutor channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get intraday recommendation calls and you can learn robo trading software for free. Now let's look at the put ratio backspread. So what is a put ratio backspread? This is an options trading strategy that combines short puts and long puts to create a position whose profit and loss potential depends on the ratio of these puts. So, a put ratio backspread is so called because it seeks to profit from the volatility of the underlying stock and combines the short and the long put options in a certain ratio at the discretion of the options investor. So it is constructed to have unlimited potential profit with very limited loss or limited potential profit with the prospect of unlimited loss, depending on how it is structured. The ratio of long to short puts is typically 2 is to 1 or 3 is to 2 or 3 is to 1. So here are some of the terminology: the maximum gain, the maximum loss, and the break-even points. So let's look at maximum profit. So the maximum profit is unlimited if the price of the underlying security is lesser than the lower break-even point, and the lower the price of the underlying security drops, the more profit is made. The maximum profit is limited to total net credit if the price of the underlying security is less than the upper break-even point. So let's look at the maximum loss. So this occurs when the price of the underlying security is equal to the strike of the leg A, and the maximum loss is limited to strike of the leg A minus strike of the leg B minus strike of the leg A, and then this is multiplied by number of options written in the leg B minus the total net credit. So let's look at the break-even point. A profit is made if the price of the underlying security is greater than the upper break-even point, or the price of the underlying security is lesser than the lower break-even point. And now let's look at the upper break-even point. So this is strike price of the leg B minus the total net credit divided by number of options written in leg B. Now let's look at the lower break-even point. This requires a strike of the leg A, then the strike of the leg B, and strike price of leg A. And here we will also need the total net credit divided by the options written in leg B. So you can put this in this equation here and you will get the lower break-even point. So what strike price is to be used in this put ratio backspread? So the main deciding factor when determining what ratio to establish the put ratio backspread with its strike price. Here are the effects of the different strike prices being used. The wider the strike price difference between the short and the long put options, the lesser in the money put options you will need to sell in order to cover the price of the long put options. The bigger the profit if the stock goes up, but the further the higher break-even point becomes. The narrower the strike price difference between the short and the long put options, the higher the potential profit, and the nearer the higher break-even point, but the lower the profit would be if the stock goes up instead. So here are some of the advantages of the put back ratio backspread. First is credit spread, and this requires no upfront payment. And next is unlimited profit potential to downside and limit profit potential to upside. Now let's look at some of its disadvantages. So the broker needs to allow the trading of the credit spreads. And next, he makes less profit than a long put option strategy on the same drop in the underlying stock. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get intraday recommendation calls and you can learn robot trading software for free.